This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms, and we are Bloomberg Businessweek Daily, and it is Thursday, July 23rd, 2026. And I got to say, we're seeing stocks under some pressure. We've got U.S. Treasury yields. They are up. Can I just lay it out there?
Please.
I am obsessed by this column from our own Simon White here at Bloomberg about how the most fundamental macro risk is back. He's talking about rising inflation volatility spurred today by a surge in oil, but he says more broadly that all of this is set to trigger earnings disappointments, wider credit spreads, and more variability when it comes to stock and bond prices. It makes investors, too, rethink valuations in a higher rate environment, which we're kind of seeing. Some things don't look as attractive. Well,
speaking of valuations, look no further than the Magnificent Seven. The total return index from Bloomberg is today falling by more than it's fallen since any time going back to April 10th of 2025. That was the Liberation Day tariff fallout. So Mag 7 rethink for those companies, including the likes of Alphabet spending and Tesla.
And this as we get ready for, another round of tariffs, or so we've been warned. All right, so we're going to kind of use that as a big theme today, the next 60 minutes, really over the next 3 hours. We're also, of course, keeping a watch on the likes of Alphabet and Tesla as the Mag 7. We're going to get a lot of earnings next week, but we obviously are seeing the trade today. In terms of what might be the ultimate macro risk and this rising variability when it comes to inflation, Jeffrey Rosenberg, he's senior portfolio manager of the systematic fixed income over at BlackRock. So we're going to talk inflation, we're going to talk the Fed, we're going to talk the reality of potentially a persistently and volatile higher inflation world.
Okay, so that's part of the world that we're living in. Also, Another part of the world has to do with reindustrialization when it comes to the United States. How does one really build ships in America?
It's a good question, right?
Okay, well, it's a question we're going to pose to the CEOs of Siemens Digital Industry Software and HD Hyundai USA about their deal that was announced earlier today.
Yeah, just a little while ago. Hey, and in the AI era, what does it really mean for robotic surgery? We're going to ask the CEO and founder of SS Innovations International. We talked with him late last year. He's back. So curious, because his share price has been pulling back. So I'm curious what he's hearing from the investor base.
All that and more coming up over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
I thank you very much, Tim and Carol. Yes, stocks lower, oil higher. Indeed, looking at 4 factors today for the sell-off. Take your pick. We got AI spending, war jitters, disappointing earnings, higher oil prices, many of those related. Right now, let's get right to the numbers. We are looking at a sell-off. We're off session lows, but still a down day on the S&P, down 104, 73.94 where we stand right now, with the S&P 500 index down 1.4%. Dow Industrials down 614 now. That is a drop of 1.2%. NASDAQ Composite Index down now by 590 points. For NASDAQ, a decline of 2.3%. The NASDAQ 100 Index down 2%. The Bloomberg Mag 7 Index is now down by 4.7%. Last night we heard from 2 of the 7 members. We did hear from Alphabet. That stock down by 6.4%. Right now we've got Tesla selling off. Tesla is down by 14.2%. The 10-year currently yielding 4.70% with that 2-year 4.35%, and the 30-year now at 5.17%. All of this with the VIX just below 20. Spot gold down 2.1%, 4,042 the ounce, and West Texas Intermediate crude up 7.4%, 93.23 a barrel on WTI. Brent closing in on 102 now, 101.74 for a barrel of Brent. Brent crude surging by 8.1%. For the first time in 10 years, the United Nations is set for a leadership change. Join us at 5 p.m. Eastern Wall Street time for a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the United Nations confronts mounting global challenges. All of this live from UN headquarters. You'll catch it right here on Bloomberg, 5 p.m. Wall Street time. Recapping, S&P 500 index down 1.4%. West Texas Intermediate crude oil 93.18 $1.18 a barrel, up 7.3%. Carol and Tim, lots going on. That is a Bloomberg Business Flash.
And it certainly is, Charlie, and you're keeping us up to date on all of it. There is a lot coming at us, including when it comes to the U.S. war in Iran. We did see, and Charlie talking about all of this too, a surge in oil spurred by the escalating Iran war, sending stocks and bonds lower. We've seen that. We've seen yields, U.S. Treasury yields moving up. Wall Street also rattled by renewed concerns over whether massive artificial intelligence investments will pay off. But this has been a narrative we've seen, I feel like, for the last year or so.
Yeah.
Easily?
Well, yeah. The AI part of it. The war part of it we've seen since the end of February.
No, right. The AI part of it,
yeah.
right. And
well, okay, so on the war part of it, in an interview with Axios, the president threatened to step up strikes on Iran, said he'll hold the country responsible for any further attacks by the Houthis on Red Sea ships, potentially widening U.S. involvement in the Middle East war. I thought, 2 weeks ago we were sort of like de-escalating, but that's not what's happened over the last 12 days.
Doesn't feel like that. So let's make some sense of it. Or we don't have to. Chris Kennedy does. He's back with us. He's Bloomberg Economics Statecraft lead. He is in the Bloomberg News Washington, D.C. bureau. Chris, I think we're all a little bit confused. President Trump earlier on the U.S. war with Iran highlighted, he has earlier in the past, go back to the beginning, how they've knocked out so many of the capabilities in Iran, decimated, maybe not using those words, but basically wiped out so much of Iran's capabilities. And yet here we are. And the president stepping up strikes on Iran. What are they going after at this point in this war? What capabilities have yet to be destroyed? And does that also mean that there wasn't that much damage earlier? I'm just trying to understand. He's obviously wanting to put pressure. Is it just talk? Is there more to be done? What does he really want to see in terms of damage to Iran?
Thanks, Carol.
Sorry.
I think the answer is, he's clearly looking for some sort of capitulation on the part of the Iranians. And yes, there have been a number of strikes. The president has claimed that Iran's Navy is destroyed, that we've taken out its missile stockpiles. Clearly, this isn't the case. Iran is a large country. It has been preparing for a moment like this for a very long time. And they clearly are also just not in a position yet where they feel like they need to capitulate. Now we see that they've successfully recruited the Houthis into attacking ships in the Red Sea, so that's putting more pressure on global markets. But I think we do expect these strikes to continue and perhaps accelerate if Trump's threats are to be believed, with perhaps some really significant strikes this evening.
Chris, on that, you talked about the sort of not the appetite, but maybe the runway that Iran's leaders have for this. What about the American public has for this? It's an unpopular war. There was the tragedy last week where several service members were killed in strikes on American bases. And then the political side of this, and we spoke a little bit about this yesterday, but we're getting some additional news over at Gas Buddy, Patrick DeHaan, saying that we could see $5.35 to $5.50 a gallon diesel in the next few weeks, national average of $4.25 to $4.40 a gallon gas. It's just as we get into August and get even closer to midterms. What's the American appetite for this right now?
I think looking at polling, obviously the conflict is not doing particularly well in the eyes of the American public. And of course, gas and diesel prices are going to be one of the big drivers of sentiment, as we're only a few months out of midterm elections. I think we should expect that gas and diesel prices will continue to rise. Yeah. We saw a pause, but now oil prices are, up above $100 a barrel now. We're going to see increased export pressure on U.S. stockpiles of both crude and products as, again, buyers around the world look to the U.S. as the supplier of last resort. And it's going to be some time for this most recent escalation to transmit through to prices, but they're going to continue to rise as that happens.
Chris, one thing I want to do just to wrap up here is I am obsessed with this column from Simon Kennedy. So Simon, if you're listening to me, but this idea of this most fundamental risk is back. He talks about rising inflation, volatility, set to trigger earnings disappointments, wider credit spreads, and more variability when it comes to stock and bond prices. We are less than 1 week away from the Fed decision. Do you agree? Are you guys increasingly hearing that the world's economies are worried about this rising inflation volatility, which has implications for everything in our world?
I think so. I mean, there's the Fed meeting, and I think the Fed will be inclined to consider raising rates, especially given that the job market is still pretty strong in the U.S., so that's not necessarily a concern. And like you pointed out, this is a great column. It's not just inflation, but it is the variability, the volatility in inflation, and this has knock-on effects on the U.S. economy. You know, consumers are going to delay purchases, especially of large durable goods. We're going to see perhaps credit spreads increase, and that could undermine. You were talking about the AI economy. So much of this is built on the build out of these data centers, and it's debt driven. And so there is a lot of risk. Inflation volatility is reaching levels last seen in 2023, and it doesn't show any signs of letting up at this point.
There's a superlative. Everybody enjoy your Thursday. All right, Chris Kennedy, I know we throw a lot at you. Always appreciate, though, your analysis here. Chris Kennedy, he's Bloomberg Economics Statecraft Lead, joining us from D.C. We do have a programming note.
Yeah, for the first time in 10 years, the United Nations is set for a leadership change. Join Bloomberg, 5 p.m. Eastern, for a special town hall with candidates seeking to become the next UN Secretary General, discussing their priorities as the UN confronts mounting global challenges live from UN headquarters. It's the UN Town Hall, the next Secretary General, live on Bloomberg Radio, Bloomberg TV, and the Bloomberg Business app. It starts at 5 p.m. Eastern Time. It's organized by the Office of the President of the General Assembly with the support of Bloomberg.
All right, we're going to stay on geopolitics and what it really means for global markets. We just talked about inflation concerns continuing to make investors nervous, this ultimate macro risk, and how it impacts everything in our world, whether it's goods prices, borrowing rates, Fed policy, and cash flows, and as it becomes more uncertain when the purchasing power of money itself becomes unstable. I'm curious what our next guest has to say about that and how it impacts his world, the world of fixed income. Delighted to have with us Jeffrey Rosenberg, Senior Portfolio Manager, Systematic Fixed Income over at the world's largest asset manager, BlackRock, which, by the way, just reported a record $15.3 trillion in assets under management. Jeff joining us right here in New York. Jeff, great to have you here with us.
Great to be here, Carol. Thanks for having us.
I want to jump right to it. This idea of rising inflation volatility set to trigger earnings disappointments, wider credit spreads, and more variability when it comes to stock and bond prices. Is it the ultimate macro risk in your view?
Well, it's one of the biggest challenges that investors face for another element that you didn't quite capture, which is the relationship between stock and bond returns. And that relationship has fundamentally shifted relative to the one that existed pre-COVID. And that is that stock and bond returns are much more positively correlated. And so investors have lost a form of diversification. And in the bond side of the equation, it's been an really important, unfortunate loss that they've lost basically insurance that used to pay for itself. And this is entirely related to inflation volatility, inflation shocks, and the fact that we're going on 5 years of above target inflation. And when you're above target in terms of inflation, it undermines the bond market's belief that the Fed is unbridled in its ability to support equity market and equity market portfolios when they need it the most, when there's a decline in equities. And so that's what you're seeing right now in terms of the challenges from the recent developments in the Middle East around oil prices, oil uncertainty, feeding into inflation uncertainty. It's leading to higher bond yields and lower bond prices at the time when equities are having their own challenges. So you've lost that diversification, and that's a huge loss, and it's something that we spend a lot of time trying to provide solutions for, but I think in this macro context, it's one of the biggest issues that investors face.
So it's a challenge for investors, but so too, I think, a challenge for Kevin Warsh next week. It'll be his second meeting as chair of the Federal Reserve. Jeff, you shared a note with us that gets into the Fed communication and credibility. What does the Fed chair have to do next week to appease investors and also appease the president?
Yeah, it's an incredibly important time. I mean, we just kind of draw back a little bit from the headlines of the day and the week. It is a bigger story around the significant changes in this moment in history that Warsh represents for the outlook for the Federal Reserve. The report that you mentioned is our third quarter BlackRock fixed income outlook piece. We go into more details in that. And one of the most important things I'm highlighting in that piece, and it's a piece with a lot of contributions from my colleagues, so it's not just from us in BlackRock Systematic, it's the entire breadth of fixed income investors across, as you mentioned, the world's largest asset manager. But one of the things I'm highlighting is just this importance that Kevin Warsh talked about in terms of trying to restore the relationship between the Federal Reserve and market participants through the role of market prices. Rather than market prices taking their direction from the Fed, he wants to reverse that back to what existed kind of pre-GFC, where the Fed could take direction from market prices. And that's not going to happen overnight, but it's a significant signal of a change in direction, an objective of how he wants to see the institution really revert back to its prior form. They wrote a piece, there's a lot of discussion around the gain of function, critique of the Federal Reserve, and I think you're starting to see with these task forces, some of the objectives of reversing some of that structural change over the last 20 years back to something that existed pre-GFC. And I think that's very consequential for investors, how we interact, how we think about the role of the Fed, forward guidance, the role of data and alternative data, and really about bringing back investor sentiment around determining prices rather than us trying to figure out what the Fed is going to do and then using that to determine prices.
Right. You've got to put all that money in AUM under management to work for your investors, Jeff. So having said that, in fixed income, I guess, changing environments, it's how do you find the opportunities? Where do you see the opportunities? What are the bets you make now that you think are viable? And I don't know what the time frame is. Investors all have different time frames, but how do you think about it for at least the next 6 to 12 months?
Yeah, and it's some of the points that we make in this quarterly outlook that, one of the big changes that is attractive from a fixed income perspective is with the normalization in terms of policy rates and interest rates, we've seen yields come back to the fixed income environment in an attractive manner. You have to take that into the context of the history in which we're talking about, where you went and really bond investors suffered through a long period of zero interest rates, below inflation yield levels that really challenged the outlook from an income perspective. One of the most kind of good news stories on the fixed income side we highlighted in our Q3 outlook is that yield perspective has been restored. You can come back to the bond markets, get yield that's above the level of inflation, maintain the purchasing power of your savings, which is sort of the ultimate charge of a fixed income part of the portfolio. But we also talk about the importance of selectivity, that we're at a period in terms of valuations, the narrowness in terms of economic growth. It's a good growth outlook, but it's increasingly determined by one theme, and that theme, of course, is AI. AI is both micro and macro. It's everything everywhere all at once. And that's good. And you're seeing that support in terms of the economic data, the CapEx, the expenditures, the technology contribution, and most importantly, the support through the wealth effect in terms of what we're seeing on consumption. Yet at the same time, that creates a vulnerability. So selectivity in terms of security selection, and benefiting a bit from some of the dispersion that we see in some parts of the market helps to navigate, is essential to navigating through the fixed income environment over that kind of time frame that you were talking about.
Great way.
Kind of quarter to 6 months.
A great way to set the table ahead of next week's Fed decision. Jeff, thank you so much. Super appreciated.
Thank you.
Jeffrey Rosenberg. He is Senior Portfolio Manager of Systematic Fixed Income over at BlackRock, joining us. When we come back, we talk a little bit about the reindustrialization of the U.S. We've got 2 CEOs. Can we actually build ships in the U.S.?
That's a good question for them.
It is.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks selling off with a triple-digit loss now for the S&P 500 index. Oil is surging, and tech stocks are slumping. Let's begin with the S&P 500 index, now below 7,400, 7,395 where we stand. That index down by 104 points. That's a decline now of 1.3%. Dow Industrials down 1.1%. NASDAQ lower by 2.3%. The NASDAQ 100 Index down 2%, and the Bloomberg Mag 7 Index is down 4.8%. This as Alphabet slumps 6.4%, and Tesla after earnings down 14.2%. The stocks, the Philadelphia Stock Exchange Semiconductor Index down 1.2%, the VIX above 19, and a 10-year at 4.69%, the 2-year 4.35%, the 30-year 5.16%. Gold is down 2.1%, $4,041 the ounce. West Texas Intermediate Crude up 6.8%, $92.74 a barrel. Brent at $101.22 now, up by 7.6%. Lockheed Martin and RTX have raised their full-year sales forecasts as geopolitical tensions around the world boost defense spending. RTX up 6.7%, Lockheed Martin up by 9.8%. And SpaceX will be attempting a major test of its Starship rocket tonight after abandoning takeoff last week, highlighting the stakes for the critical milestone. We'll have the launch for you live on Bloomberg, 6:45 Wall Street time. Shares of SpaceX, they are gaining now by 1.2%. By the way, you'll recall it IPO'd a couple of weeks ago at $135. SpaceX shares now at $116. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
135, so at 116, it's definitely below that IPO price, so keep an eye on that. All right, Charlie, thank you so much. Hey, we just want to call your attention to, we are keeping an eye on President Trump. He is at the EPA. He is expected to make an announcement on the Ratepayer Protection Pledge. That's a pledge that seeks to protect households from absorbing utility costs tied to data centers, which we know have been so much a part of the AI build. So we're going to monitor any comments that he may make.
Yeah, the president just beginning his remarks right now. We'll bring you anything of note that he says throughout the program today. You can also check it out on Live Go on the terminal.
Good stuff. So we're going to keep an eye on that for you. Hey, also on the president's agenda, that is domestic shipbuilding and shipbuilders who could receive billions of dollars under the National Defense Authorization Act that the House passed just yesterday, approving it. Latest sign of congressional initiative in reviving the domestic maritime industry to undermine Chinese commercial dominance on the high seas. President Trump has said some mixed messaging, though, when it comes to his devotion to the cause after releasing a plan about a month ago.
It's been on the president's mind, though, for some time. He's talked about building ships in the U.S. for quite a while, including just after returning to the White House early last year, in March of 2025, when he gave a joint address to Congress.
To boost our defense industrial base, we are also going to resurrect the American shipbuilding industry, including commercial shipbuilding and military shipbuilding. And for that purpose, I am announcing tonight that we will create a new Office of Shipbuilding in the White House and offer special tax incentives to bring this industry home to America where it belongs.
All right, that, of course, was President Trump, March 4th, 2025, when he gave a joint address, I should say, to Congress. They're talking about shipbuilding. But on this, what's interesting, there was an announcement actually earlier today in Washington.
Yeah, formally announcing the signing of a 9-figure deal that establishes Siemens as a key technology partner for HD Hyundai's next-generation shipbuilding and digitization strategy. Those two companies formally announcing that deal earlier today.
With us right now is Tony Hemmelgarn. He is president and CEO of Siemens Digital Industries Software. And also with us is Sek Hwan Hong. He's the president and CEO of HD Hyundai USA. And again, they both join us from Washington. Gentlemen, welcome, welcome. Delighted to have you here on Bloomberg. Tony, I want to kick it off with you. What does this deal solidify specifically and mean for shipbuilding here in the U.S.? What does it mean for you, for the two companies, but what does it mean for maybe shipbuilding more broadly here in the United States?
Yeah, so we're very proud of the partnership here with HD Hyundai, and a big part of that was how do they move faster? How do they build ships faster? How do they design, engineer, and manufacture faster? And so what our software is we provide the tools that allow you to do that. And so when you think about then advancement of shipbuilding here in the U.S., part of the announcement today between the U.S. and Korean governments is how do we promote more of that commercial shipbuilding here in the U.S. And our tools are the tools that help you do that, to help you go a lot faster, to create that digital environment, to be able to produce, manufacture and engineer. So it's something that's a key enabler to be able to promote this business here in the U.S.
Sek Hwan, I want to talk to you about what it takes to actually build a ship in a sustainable way here in the U.S. rather than in another part of the world. Specifically with a deal such as this, how do you pencil it out and make the numbers work for you and for Hyundai?
Well, we see great momentum from the Hill and the strong leadership from the U.S. administration. But at the same time, when it comes to the reality and the day-to-day operation, there are many challenges. One of the great challenges that we are facing here in the United States would be a shortage of labor, especially the skilled labor. And what the digitalization, the digital shipyard that we are building together with Siemens do in that relation is to create a virtual 3D type digital shipyard where everything is connected. All information come together, and by that we make a better decision and optimize our resources. Better. In that way, we think that it will enable us to faster automation and digitalization and AI empowerment. In that, we can solve the labor issue here, and that would be a powerful tool to have here.
So, Sek Hwan, let me just follow up on that. So, how much can a digital shipyard basically reduce construction time for, let's say, a destroyer, a submarine, or an auxiliary ship?
Oh, that's a great question. We don't gauge the success of the digital shipyard thing in terms of the time that we reduce. What we focus more is whether. Well, let me put it this way. We believe with this digital tool, on time and on budget delivery will be possible in a more efficient way. So we try to reduce the time, but more focus, I would say, for now, is to keep the time and the labor force ready for that on-time delivery.
Yeah, Tony, that's a good question to you too, and about this labor force and the way that digital tools, in your view, are offsetting some of the challenges that the U.S. industrial base has, or the U.S. labor force has here. Given the shortages of welders, how much can these digital tools offset that shortage of skilled welders, pipe fitters, and electricians?
Yeah, I guess I'd first start, though, with just the design, right? And that
before we even get to the actual labor that it takes to physically build this.
Right, because you've got to get the design right, you've got to get the engineering right, the physics right of the product. And we talk about this as a digital twin. And the idea of the digital twin is how closely the digital world can represent the real world. And the closer we can make that relationship, the faster companies like HD Hyundai can go. Because you think about these products, they're highly complex. You've got software, you've got mechanical design, electronics, electrical, manufacturing, engineering, the plant layout, plant simulation, all of these things. If we can simulate that, this is a very complex environment. The complexity is not going to go away. But if I can simulate it and I can do what ifs and make changes and other types of things, that allows me to go a lot quicker. And once I do all of that, then it comes to what do I do with welding? What do I do with the simulation of what happens in the plant? We bring all that together. And this is where you really start to get the value of what our software can deliver. Because now I can make these decisions in confidence in a very complex world. And that's truly a competitive advantage. If I can simulate and do all of that work much faster than the next guy, it's a big advantage. And so we take that, and then also these tools are enabled for the workers. They can use these tools. We can simulate what the workers are going to do. We can show them how to perform the work, to provide the work instructions, all of these types of things. So it's really assisting what's going on, as well as programming the robots, simulating the robotic simulation. All of that is part of our software.
So, Sek Hwan, let me go back to you then. So I get it, like the timing, and it sounds like things will be much faster. So give us an idea. I want to go back to so how does this change output? Can you give us some kind of, we're into numbers here, some context in terms of 6 months, what gets changed, 12 months? Give us an idea of how output is changed especially when you've got a president who we're monitoring right now and talking about data centers and so on and so forth and power, but also thinking about shipbuilding, which he has talked about, and increasing that. Because many people have said you can't do this quickly in terms of the U.S. shipbuilding industry, change it and increase it. It doesn't happen overnight.
Well, the current timeline that we have in mind is to be able to apply this digital shipyard concept to our starting the design in 2028. But that will be the starting point in reality, and it will take some more time to develop a program to cover the whole shipyard and the whole the entire ships that we built in our yard.
Well, and then, so, I want to bring you back here in on this conversation, Tony, when it comes to timelines. Like, what's the timeline on you on how the pressure, the demands on you guys in terms of delivering the software and the changes that are needed to kind of basically modernize the shipbuilding industry here in the United States?
Yeah, the software is here and proven now. It's established. So we have software. We sell the software all the time. The work is for us to integrate that into the workflows and the way that HD Hyundai works, for example, and how they design. And we do a lot of this all over the globe. Most manufacturing and engineering companies in the world use some portion of our software. And so we have what we call a digital thread. The idea is, how do you get from point A to point B in a design process? Like you mentioned things like sustainability or whatever it might be. We can simulate, for example, that ship flowing through the water and the resistance of the water at the same time, the resistance of the airflow in the ship as it's going with computational fluid dynamics. From that, we can determine how efficient we can make the product, how we can reduce energy, how we can lightweight the product. So we have all of these processes established. And now what we do is we sit with HD Hyundai and establish them in their workflows. And this is work we've started already. So we feel very confident that we can go very quickly in the design, engineering, and manufacturing process. Of course, building out some of the work in the plants takes a little bit longer to what we're doing, but the software is ready to go now.
Right. So you guys are ready to go. It's just a case of integrating all of this into the existing systems that are there at Hyundai. Gentlemen, fascinating as we continue to see and talk a lot about the reindustrialization of the United States. Some say it's really difficult, but you guys are doing it with this announcement. I hope you will come back in a few months and let us and give us a status update. We'd really appreciate it.
Great. Thank you for having us.
Congratulations. All right, folks, we are continuing. Tony Hemmelgarn, he is President and CEO of Siemens Digital Industries Software there in D.C., along with Sek Hwan Hong. He is President and CEO of HD Hyundai USA. So interesting stuff there. Hey, when we come back, a check on robotic surgery. We're switching gears a little bit.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Oil pushes higher. Stocks are lower. In fact, the S&P 500 index now on track for its worst day in a month. We've got the Dow, the S&P, NASDAQ all in the red. S&P down 1.4%, setting a baseline for us at 73.93. The S&P now down 105 points. The Dow is down 593 for the Dow Industrials, down 1.1%. NASDAQ is down 2.4%. The Nasdaq 100 index down 2%. The Bloomberg Mag 7 index hit particularly hard today, down 4.8%. This after earnings last night from Alphabet and Tesla. Alphabet now down by 6.7%. Tesla shares are tumbling by 14.2%. The 10-year currently yielding 4.69%, with the 2-year at 4.35%, and the 30-year now at 5.16%. Gold down $84 the ounce to $4,045. That is a drop of 2%. West Texas Intermediate Crude is now surging by 6.1%, $92.11 a barrel. Brent crude above $100 at $100.62, up by 7%. Earnings news. T-Mobile reported revenue that missed analyst estimates amid modest gains in subscribers, disappointing Wall Street's high expectations. T-Mobile down now by 7.6%. AT&T, which reported yesterday, does remain lower today, down 9 0.9%. Tomorrow morning, we'll hear from Verizon. Verizon shares now lower by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thanks so much. Hey, we got a few developments from the world of robotic surgery. After more than a decade of research and years of delays, J&J now has a robot on the market for soft tissue surgery. That news came out yesterday. Meantime, Intuitive Surgical shares, we saw them under pressure again last week as growth in the use of its Da Vinci surgical robot slowed to the weakest pace in 4 years, and its guidance for procedure growth was unchanged due to softer U.S. growth in procedures reflected because of changes to Affordable Care Act subsidies. Company also said, I thought this was
This is so cool. I mean, so interesting, right?
Yeah, that U.S. Da Vinci bariatric cases in particular experience pressure from patient usage of GLP-1 weight loss drugs.
So fewer people are getting bariatric surgery because they're using GLPs instead.
That's the read-through.
Okay.
Yeah.
Curious if any of this at this point is affecting our next guest. Back with us, Dr. Sudhir Srivastava, Chairman, CEO, and founder of the U.S.-based SS Innovations International. It makes medical equipment. It develops surgical robotic technologies. It's a $683 million market cap with U.S. shares down about 40% this year. He joins us from Fort Lauderdale. Good to have you on the program. I think a lot of people, when they think surgical robotics, they think about the Da Vinci machine from Intuitive Surgical. How does your product at SS Innovations International differ from the Da Vinci surgical robot?
Yeah, it's a great starting question. First of all, thank you very much for having me. So the SSI Mantra system is different than Da Vinci almost at every level, other than fundamentally it is still a surgical robot. So, we can go through some brief comparison on the technology, open-face console as opposed to the immersive and thrower, up to 5 arm control from the console, large open-face 32-inch 4K monitor. Tableside team also has the same 3D view, which is safer and more efficient. And then a modular design of the robotic arms, 3, 4, or up to 5 arms. And moreover, our system is equipped right from the beginning, both for teleproctoring and telesurgery.
What about from the perspective of the doctor actually using the technology and how difficult it is to train? All these doctors are used to using certain products right now. How do you train the doctors to do this?
Yeah, so we have gone through, of course, in India, we have sold 224 systems. Almost 13,000 cases now have been done, including cardiac. So essentially what we have observed, the people who are Da Vinci users, it almost takes them anything 5 to 10 minutes literally, because it's like driving a different car. So once they understand the controls, same principle essentially, the hand controls, foot controls, operating, watching the video. People who are non-robotic surgeons, it can take them from 20 to 30 minutes to learn the machine. Then of course they have to go through certain practice, just to get used to things, just like in Da Vinci. There is a learning curve, and so there is a learning service, our system, for the novices.
And you don't sell in the U.S. yet, correct?
Yeah, so we are actually in the process with US FDA. And again, our anticipation is by hopefully first quarter of next year, we will achieve some approval from US FDA.
Right. I know this is some of what we talked about last year. I am curious what you hear from the investment community, because as Tim mentioned, I mean, you think of Intuitive Surgical, right? They're a $117 billion market cap company, a very known name. And you did talk about the distinctions. Do you anticipate that the U.S. market is really your growth opportunity? Because I understand your mission is about making robotic surgery more accessible to more people and also making it more affordable.
Yeah, so we have actually achieved that, in terms of the pricing, consumer goods and service agreements, etc. And outside of India, we are currently in 14 countries. So I think when you think about the growth opportunity in USA, absolutely, because our system does every single thing that Da Vinci does and more in terms of the capabilities, user-friendliness, features, and specialties, including cardiac surgery. And it will be, by the time we come to US, it will be somewhat less than half the price that of the DV5 with, again, better opportunity. So I think we feel that there's a great opportunity in US as well once we get past FDA And also the whole ambulatory treasury center market. Our system being modular, a 3-arm system, which is a full robot with all bells and whistles, is a great opportunity for ASC. And again, at an affordable price. So I think not only we are targeting hospitals, and I've been approached by literally every major hospital in the country, the big names that you can imagine. And also
in the U.S., you're saying? You're saying in the U.S.?
Yes, yeah, that's correct. Yes. I mean, the Cleveland Clinic, Mayo, University of Chicago, I mean, all the big names, not only they are friends of mine at different levels, but they're very interested because the technology now has been commercialized, at least in India, it's clinically validated, and safety has been proven.
Dr. Srivastava, one thing I want to ask you, though, investors don't seem to have conviction behind you. The time when we talked with you in last November, you guys were over $1 billion market cap company. I know it's just one metric, but you're now about $683 million in terms of market cap. The stock's down 40% year to date. What do you hear from your investor base? Because if you guys are just about a year away or so from or being in the U.S. market, and it sounds like there's support, why aren't investors agreeing with you?
Yeah, I think first of all, as I'm sure you know more than anybody else, the stock markets fluctuate. I mean, if you look at Intuitive, a year ago, what $200+ billion was raised now. And huge value they've lost actually. And these things happen, I think, for a variety of reasons. Moreover, I think the biggest thing that we hear from investors, they are waiting for us to get the U.S. approval, and they want to see U.S. revenues. And that is, I think, the primarily, and moreover, we were like a submarine. We finally have surfaced. And now more and more analysts actually are, in fact, I'm here, there are several interviews scheduled with the known analysts actually. I think once the coverage becomes available to the investment community, I think things will gradually change. And I think the key bottom line is this really, I think they want to see U.S. revenues. And that's how I think it fluctuates. Right?
Well, to add on to that, I mean, Intuitive Surgical, it's a market cap of about close to $120 billion. You guys are sub $1 billion. Dr. Fred Moll, who is a founder of Intuitive Surgical, is your vice chair. Now he believes in your product. That's it. I would think a lot of people would look at that as a huge feather in your cap. Very briefly, why don't you sell? Why would you sell yourself to a company like Intuitive Surgical?
You know that I cannot answer that on this call. I'm sorry. I'll have to refrain that. But with a caveat, let's say if they made a proposal that absolutely we cannot refuse, we are a public company. It will have to be brought up to people, board, and decisions will be made there. I'll leave it at that.
All right, so we can assume that there's been no proposal yet put before you?
Well, there have been people, strategists, they looked at us, and again, under the NDA and all that thing. And I'm sure you can appreciate I cannot get into some of those details.
We do. Stay in touch and let us know as you move closer in expectations in terms of the U.S. market. Dr. Srivastava, he's chairman, CEO, and founder of SS Innovations International. We're back in a moment.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody. It is Thursday, July 23rd, 2026. Carol Massar along with Tim Stenovec live here at Bloomberg headquarters in New York City. It's kind of one of those days. I'm just going to say that. We are seeing some pressure, though, on the overall trade, down about 1.4% on the S&P 500, down more than 100 points. You're looking at about a 1% decline in the Dow Jones Industrial Average, down more than 2% when it comes to the NASDAQ 100, 601 points to the downside. We have been seeing selling, though, in some key movers when it comes to these major averages. We're talking about Alphabet and Tesla. Yeah,
I mean, the Mag 7 collectively, the Bloomberg Mag 7 Total Return Index is having its worst day going back to April of 2025. That was with the tariff-induced sell-off that we saw post quote-unquote Liberation Day. So investors are sort of rethinking, I think, CapEx, it's fair to say.
Deja vu all over again. We go back and forth here, right? Yep. Get some bad headlines or some worrisome or, even any kind of interpretation that maybe the AI trade isn't all that. And so you do see investors getting a little bit nervous. And it also, I would not rule out that this whole concept of in a higher rate environment or where there is more volatility when it comes to the rate environment, you look at valuations differently too, and that kind of exacerbates some of the nervousness that's out there.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move today. We're joined by Bloomberg News senior equities reporter Jess Menton for some stock movers. Hey, Jess.
Starting with Tesla, TSLA. So we're talking about obviously CapEx weighing on the back of the earnings that we got after the bell yesterday with Tesla as well as Google. So I'll start off with Tesla. Looking at that stock, TSLA is the ticker, down 14%. So this is the biggest percent and point decliner in the S&P 500 today. And right after that, on a point basis, is Google. So obviously you're seeing more of, especially the Mag 7, you were just talking about its biggest decline that we've seen on a daily basis since basically the tumult that we saw during the tariff tantrum. But also even before today, you would have already seen the Mag 7 index lagging the broader indexes because you already saw a divergence in the trade between what was going on there and what was going on with chip stocks. What'll be interesting is looking forward to next week because that's when we'll get more earnings results from the biggest customers for NVIDIA. So Meta, Microsoft after the closing bell next Wednesday. You'll have Amazon after the bell next Thursday, but then also Apple too next Thursday. But what's interesting, if you look at all of the Mag 7 stocks, of course, Apple's down almost about 2%, but it's the least hit and also the one that spins the least when it comes to CapEx. So when you tie a lot of that together there, that's what's interesting, just given, well, next week we hear the same thing from those types of stocks and those companies.
Blown away by these companies. And we've always talked about all the cash on their balance sheets, and now we're talking about negative cash flow.
And,
right?
But also, if you look on the other flip side of that.
Gotta spend money to make money, Carol.
The AI infrastructure trade, you still have Micron, Western Digital, and then U.S. listed shares of Sek Hynix higher today. So in a different direction there than some of the other
you get it
tech
all.
stocks. See?
Just one stock from Jess Menton.
Just wait.
You don't need anything else.
Wait less than 24 hours and we'll see what happens tomorrow. That's all I'm going to say. All right, so Tesla, as you said, Tesla there. Following that one, American Airlines.
Yes, I wanted to get into what was going on with oil prices today because energy, on the flip side of that, if you look in the S&P 500, one of the best performing industry groups, but discretionary is one of the worst. Obviously, Tesla's housed in there as well as Amazon. But American Airlines is no longer in the S&P 500. It got booted almost 2 years ago, but it's in the S&P 400. So it's one of the worst performers as far as that particular index. But if you look at the other passenger airlines, so AAL is the ticker for American Airlines, down almost 8%. On pace for its worst day in almost a year, July 24th of last year. So basically, that would be tomorrow to mark 1 year there. But then the passenger airlines index and the S&P 500, that's down more than 3%. So on pace for its worst day since July 7th there. But on the flip side, energy, of course, still performing well. So if you're looking at an Exxon or a Chevron, those moving higher today.
Yeah, no surprise about that one. All right, let's go to ticker ALLE.
Yes, so this is a lock manufacturer and physical security company, Allegion. So it boosted its full year profit outlook. So it expects adjusted earnings around $8.85 to $9 a share. So it's well above the consensus estimate there. It's still down about 13% from its record high that we saw in February, but you are having just industrials in general as the best performing industry group in the S&P 500 today. It's up more than 1.5%, and energy's right behind it, up around 1%. But also, United Rentals is higher too. URI, that's also an industrial stock. It's the world's largest equipment rental company. You also saw a guidance boost from them. And behind that, RTX, it's an aerospace and defense company. So the ticker is RTX. So it also boosted its outlook on high demand for weapons and engine parts. So basically, industrials moving in a very different direction than when you're looking at what's happening in discretionary and communication services. But that's obviously where most of those big tech companies are housed.
What I love about Jess Menton is you get a lot for your money with stock movers. Because typically you get 3 stocks. She brings the 3 stocks plus some friends.
I try to put in some narratives with that. I was just going to add, we were talking about American Airlines. What I meant to say was also it reported a lot, but it warned that it could potentially report a loss this year tied to higher fuel costs. That's also, you have Brent hitting.
You can only offset so much with higher ticket prices.
Yeah, right. There's, the longer this goes on, the more problematic or the more quarters it hits when it comes to those publicly held companies. Just thank you.
Yeah, a lot of moving pieces today.
There is, and you're on them all. Jess Menton, Bloomberg News senior equities reporter. Check out our Stock Movers podcast. 5-minute episodes, winners and losers. Find it on Apple, Spotify, or anywhere you get your podcasts.
Coming up next on Bloomberg Businessweek Daily, if you're sticking with us on radio, YouTube, or Bloomberg Originals, we're talking what's moving this Mag 7 on TV. The close starts now.